Good evening, sir.
Michael.
Good
Yeah,
evening,
good
sir.
evening, Michael.
Yes, I have question concerning the last question we stopped in class, which is TLPLC.
Okay,
Hello,
I'm
can you
with
hear me,
you.
sir?
Go ahead.
Okay.
Please go ahead.
There is this particular place after the breakdown of the financial statements where they put after the loan stock price, equity beta, there is a two asterisk there that I'm a little confused about the second one, which is TL 12% loan stock 2027 to 2029. I don't know what they mean by that year, 2027 to 2029.
Leave them now. Leave them now. That is what the it is what it is, Michael. That is the long-term loan stock. They are telling you when they will pay it is redeemable loan stock. They are telling you what the time at which they will pay back the loan stock. So
Okay,
that
yeah,
is it.
that's where I'm having confusion. Because if it's a redeemable loan
No,
stock,
it wasn't stated that it is redeemable, Michael.
okay,
It
okay,
wasn't
okay, okay.
stated. Just leave. They are telling you that they will pay this interest to this to this. So it wasn't stated that this loan stock. Oh, is there any way that is stated that this loan stock is redeemable? No.
Okay, I get now.
So,
I guess now.
right. Thank you. Please, any other question? Okay, I guess we are good, right? We are good. Okay. Good evening, everyone, once again, and you're welcome to another edition of our lecture on strategic financial management. We shall continue with our lecture on project-specific cost of capital, right? And let me quickly say this again, that please, I don't appreciate DMs, right? Because recently I got some DMs that I was like, you don't need to ask me this kind of question. You don't need it. You don't even need to come to my DM and tell me that this is it. Just post to the platform, I'll see it, right? Post, imagine FM student doing the same thing. Imagine CS student doing this. Imagine PM student doing the same thing. So how will I even attend to some other issues, right? So please, we should, right? We are all professionals, right? So please, whatever thing we want to do, drop to the. I think someone is coming to my platform to the my DM asking me that is it bond valuation? Is it this? Is it that? You don't need to come to my DM and ask such question. If you are confused about whether there is bond valuation in the syllabus or not, immediately when we are in class, if I want to take you bond valuation, you can decide not to even join. You go, then we move on, right? Because these days I don't even have strength because a lot of because I need to just show some DMs. Like I need to just show some DMs. The same questions that have been answered, you just keep on asking the same questions as well. So please, I'm begging every one of you, right? So please, we should just tag me, just tag IB Ibrahim. Just you can call me IB or Ibrahim. Just say, okay, IB, this is my question, and you want me to answer your question like in the next 30 minutes, right? I will tell you that okay, just give me some minutes. I will attend to you. Thank you. Now,
Sorry.
no, it's fine. It's fine. It's fine. Thank you. Thank you. So, now our previous lecture, right? I think this question seems to be new because most times I've seen they will not give you two proxy company, right? In this question, we're given two proxy company, right? We have to look for the average beta, please. We have to look for the average asset beta, right? After that, we move to the next step, right? And we should not forget that this company talk about they want to go into two projects. One, they want to actually expand their products. Either they want to expand into existing operation into textile, and as well as they want to diversify. We have equally touched the area of diversification, right, into the packaging industry. Right now, it is the tester. Don't forget that this tester is just an expansion. It's for the company because it is just for an expansion, not that the risk will change. The risk will not change. It is still for the company, but they want to go into the what? Expansion. The risk remain the same. They are not diversifying, right? So therefore, this tester, we are going to use the normal cost of capital without diversification, because this is just an expansion of a business, right? Class, am I communicating, please? Am I communicating, please?
Yes,
Okay,
sir.
that's fine. That's fine. Thank you. So, based on this, right now, please, another thing, something just came to my mind now. Another thing, I know, right? I know, even before I qualified, right? I know most of you will have something that you want to say, like you don't want to like share it to the general platform. I know, I understand, right? I understand. You can just, in that general platform, you can just say, okay, IB, please, can I send you DM? Please, it's just very important, right? So I can quickly relate that before. I'm still a student self, because I'm still studying together, right? So please, if you have something that is you don't want to share to the general platform, right? Just tag me and say, okay, please, please, can I send you DM? Then I will understand that yes, it seems this is a serious issue, right? So you cannot send me DM. I will respond as okay. So just give me some minutes, then you can send DM, right? Thank you. Now, expansion into textile industry. Now, excuse me. So we need to. Oh. Okay, so we need to expansion into textile industry, right? We need, of course, we need to determine the weighted average cost of capital of the normal expansion, right? Without diversification. And don't forget, what is the requirement? Determine whether 15% per year is an appropriate discount rate to use for each of these projects, explaining your answer and state clearly any assumption that you make. And don't forget that the TM managers are proposing to use a discount rate of 15% per year to evaluate each of these projects. They are just making an assumption of 15%. So we want to determine if the 15% is actually appropriate or not, right? Whether it is appropriate or not. We've calculated the weighted average cost of capital for the diversification. Now, for the expansion into Tesla. For the expansion into Tesla, there is no risk that is being attached to it. So we just calculate the usual weighted average cost of capital, our normal, without adding any risk, because it is still the same industry. Class, it is still the same what? Industry. So therefore, we can have weighted average cost of capital. What do we need? So we've determined the cost of equity already. So let me quickly copy this, right? Let me quickly copy this. So weighted average cost of capital. Okay. Weighted average cost of capital. So we bring out the variables, right? So value of equity. What will be the value of equity? The value of debt, right? We've done this before, we just pick them, right? Cost of equity, we have it to be 15. We can say it is 16%, or let me say 15.6 or 16%, right? 16%, which is 0.16, right? Then cost of debt, right? Now, value of equity of the company, class, the value of equity and the value of debt. Now, let's quickly go back. Don't forget, it is for the whole company. Is that not so? Now, let's quickly go to this paragraph. TL proposed to finance the expansion of textile operation with a 47.27 million loan stock in issue, right? With what? 47.2. So this is their value. This is the market value, value of debt. Class, this is the what? This is actually the what? The value of debt, because we are talking about textile, right? This is the value of what? Value of debt. Now, what will be the value of equity, class? And the packaging investment with a 92.7 million right issue. Can you see? Now, when you want to determine the weighted average cost of capital, it is for the whole firm, right? It is for the firm, both the expansion as well as what the packaging, right? But then that is why we have to use, for the value, for the market value of debt, we have to use 47.27 with the interest rate of 11%. The 11% here, which is the interest rate, we were not told that it is after tax. So therefore, we need to consider a tax relief, right? Then the right issue, the issue here, which is the packaging, we need to consider it to be what? 32.7, which will be the what? The value of what? Which will be the value of equity. Class, am I communicating, please? Am I communicating?
Yes.
Am I the only one in this class?
No.
Yes, yes.
Okay. That's fine. So where are we, safe? Okay, so 47.27, right? Please, you have to give me the figures. Sorry, for those who have the material, you can quickly pick from that side. 47 point what? 2 what?
27.
27. What is the
27.
value of debt? What is the value of debt?
So that 47.27, I think that's the value of debt itself.
Okay. Thank you.
Excuse me, sir. For that value of debt, okay. Did they give us a tax rate to deduct to charge for tax effects?
For the value of debt or cost of debt?
The cost of debt, yes.
They didn't tell us if it is not after tax. It is post-tax. It is pre-tax, sorry. You can see they give us 11% now. Is that not so?
Mm-hmm.
Is that not so? So it is pre-tax. There is no tax relief yet. Do you understand?
Yes.
So if there is tax, if it is post, it would have been mentioned that okay, the cost of debt to it is post-tax or after tax. Right? So, and we have here 92.75. That is the value of equity is for the firm, right? It is what? It is for the firm. So we pick the value of debt for the textile, then we have to add the packaging because it is for the firm. We are talking about the firm, not only one place, not only one. We are talking about the firm. The only thing is that we will not include diversification because we'll treat that one in the what? In the first stage. Right? So 92.75. 92.75. So the cost of debt is 11%, right? Is 11%, and we need to look for 1 minus, what is the tax rate for the company? What is the tax rate? I think we used it in our previous class, right?
33.
The tax rate is
33%.
33%.
3.33.
So what do we have here?
7.37.
7.37.
37.
Okay, more 7%. That is 0.07. Right? So I can copy this and restate it here to be value of equity 92.75. Cost of equity calculated, that is 16%, 0.16. The value of equity, I can still use ash total. I can still use what? Ash total, right? Value of equity 92.75. Value of debt 47.27. Value of debt 47.27. We've taken the tax effect. You know, if we've not done it, I've done it already here, so there's no point of me rewriting it again. All right, class, I've done it here already. That is 1 minus tax rate, right? I've done it here already, so I just need to bring in my 7%, 0.07. Right, so please,
0.67.
I don't understand. How many percent is this? This cost of debt here?
So 1 minus 0.33 is 0.67.
Yeah, I don't know now. I'm not with calculator yet. I just need final figure. What is the cost of debt?
0.67.
0.
How is this 0.67? I beg, that's not true.
0.74.
7% is correct.
It's 7%.
7% is correct. 2 points.
7% is correct.
7% is correct.
Okay, that's fine. So what is the weighted average cost of capital for the whole firm? What is the weighted average cost of capital? What is the weighted average cost of capital? Final figure.
Into 12.82%.
12.82.
Yeah.
Okay. 12.82. I guess 12.82%. I guess there is a mistake from the question. I don't know if you observed the mistake or is an error. Actually, there's no mistake, or it's an error though. You can see that in this place you have 47.27 million, right? Right. In this, at the beginning of the question, they wrote 47.25. Can you see? So we can, since we are using 47.27, so let's just stick to 47.27. Are we still together? Are we still together, please?
Yes.
Yes.
Okay. You can see that at the beginning they wrote 47.25. Why here they wrote 47.27? So I think it's from the question actually. There's a slight error there. So yeah, I've just corrected it to be 47.27 so that you not start looking for figure up and down and say, IB, this is 47, it is 47.25. Why are we using 47.27? I beg you. Nah, error, right? should be 47.27 and 47.27. Now, the question now, please, you should not forget all the basis of our assumption that I said you should state in the question in our previous lecture. Please just mute your mic, please. Can you just mute your mic? Is that now? Who is disturbing us in this class? The person is against us. Okay. A minute, please. Let me set up. Oof. Okay. So, class, you should not equally forget the assumptions we've made, right, when we are discussing. Now, using this now, you have to decide. You have to do what? You have to decide if it is appropriate to use 15% to discount the project. Now, what will be your response? I think you want to go further because you have to write, you have to explain. Right? This is 18 marks. This is 18 marks. Okay. This is what? 18 marks. You've calculated what you've have your calculation. Yes, we've seen your calculation, right? And you have your weighted average cost of capital. The question says determine whether 15% is appropriate, right? Now, based on the suggestion, the suggestion of the words of the managers, 15%. Now, in the first case scenario, is it appropriate? Is it appropriate? Is it appropriate? Class, in the first case scenario, when we have 14.6%. So is it appropriate?
Yes.
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 Why is it appropriate?
Same value.
No, it's not the same value. If I have 14.6%, it's not the same value.
I think because the risk is still the same.
Now, the 15%, you can tell the okay, the 15% is not appropriate because the 15% does not include the risk, which is the business risk of the diversification. However, the 14.6% is closer to the what? To the 15% suggested by the managers. Class, the way I normally do SFM is I put myself as, please, assuming you are the financial manager, assuming you are the portfolio manager, assuming you are the financial planning officer, assuming you are the what? The investment analyst or as a senior financial analyst. Now, the manager suggested 15%. Now, what basis did you use to arrive at 15%? And it be established. One, you cannot consider it to be appropriate because if you are using 15% to discount the project, what is the implication? The implication means that the project may not include the risks of the business, of the diversification. It may not include it. And what are you trying to do? You are exposing the investors to what? To risk. Okay, you use 15% to discount the project, right? You use 15% to, and it gives you what? Positive NPV. You'll be happy as a financial planner, right? Oh, this makes sense. Oh, as a senior financial analyst, oh, makes sense. Without considering the risk, adjusting for risk that the business may face on the long run. So that 15%, you just like, you receive salary of 50,000. You look at it. In real term, you are not collecting 50,000 in real term. What is the inflation rate? What is the NPR rate? Even if NPR does not even affect your salary, what is the current inflation rate? 22.2%. So in real term, in actual in actual sense, you are not even collecting 50,000. So it is what it is. That is why that 15,000 that 15% there may actually give you positive NPV, right? But it does not include the risk, right? The investors will ask question: did you factor in risk? Where are they? Are they included? So it is not considered to be to be appropriate. However, the second part of it, which is the textile class, the second part of it, which is the textile, that gave us 12.8%, right? It is not also appropriate. It is not what? Appropriate, because it does not include the what? The financial risk. Please, can you hear me? Are we still together?
Yes, we are.
Yes, sir.
I'm with you, sir.
Okay, that's fine. That's fine. So the 12, I hope you are writing, right? I don't like to write to, please. You should just have to write. I usually put something, well, 1,547. Okay, that's fine. So 12.82%, right? This does not include the risk. It is not also appropriate, right? Now, what is appropriate is the 14.6% calculated, because it includes the risk adjusted. It includes the risk adjusted. So that is the 15% assume it. The manager should justify how he or she arrived at 15%, right? So we are done with that question. A question. Do you have question? Are we still together?
Hello, sir.
Yeah, I'm with you.
Please,
I'm with you.
they should check the computation of this work again. I'm getting 12.96.
Okay. Okay, I'll check. We'll check it again. Tunde, quickly.
Okay. Good evening, Mr. Ibrahim. My question: why do we maximize shareholders' wealth if we consider the risk involved, sir? Because you are talking about if we are using 15% straight. Because our aim is to maximize the wealth of the shareholder. So I want you to clarify that area for me, sir. Thank you.
Okay. Now, if you are using 15%, okay, a practical illustration, you use 15% and it gives you positive NPV. Now, there is current reform now, right? What is the current reform now? Yesterday or today, right? Nigeria President signed Insurance Reform Act of 2025. Now, you've already evaluated the project using 15% to be positive NPV without including risk. You don't know that if you factor in that risk, if you remove it, what the investors are expecting will reduce. It is normal. It makes sense than not even including the risk. At the end of the day, Shebi, you tell me, you told me now, Oga Tunde, you told me that if I invest in this project, I will have 6%. Okay, why is it 4%? Then you now start to explain. You will now explain tire, right? Because of the reform, because of the capitalization, because of the tax reform, because of this, because of the inflation rate, because of the NPL remain 27.92%, because of, you start explaining. So it's better for you to adjust for the risk. So the 50% is not justifiable. How? What, on what basis did you use it? That is why there is a risk-adjusted cost of capital when a company is diversifying. It will be different from the normal WACC. The WACC will have to include risk because of the diversification. Do you understand?
Yes, sir. Thank you, sir.
Thank you. Tochukwu.
Okay, good evening, sir. Please, can you hear me?
Yes, I can hear you.
Okay, thank you for your lectures once again. Please,
Thank
that
you.
the total work for the firm, I just want to know, is it same thing as work of a combined company?
No. You are taking us to another part of another topic. My favorite, merger and acquisition. That's it. It is not.
Okay,
we are talking about the same firm. We are not combining other business. We are not merging. It is not a merger. We are talking about expansion and diversification here, not that we are trying to merge. Do you get?
Yes, sir.
Do you get? Okay.
Yes, sir.
Thank you. So please, someone should confirm this. And don't forget the basis of our assumption we mentioned in our previous class. You can include it because the question says explain and give your assumption. Please, someone should confirm if this is correct, right? 12.82%, so that we can move forward, please. I have one question to solve before I close the chapter of project specific cost of capital.
I got
so
0.36.
Okay, that's fine. So class, I can tell you this for free that anything that has to do with cost of capital, project specific cost of capital should not be major problem now, because go and check past questions. Just go and check. You will see that, oh, I've prepared you to, like, I've looked at the worst case scenario. If you look at some of these questions, there are some questions that we will not even solve now. We'll solve that maybe during intensive class, right? For those who will continue with us in that part, right? So there are some of the questions here. We will not solve it now. We'll just reserve it. But just go and focus. Go and do all those past questions, all those simple questions in that past question. Just go and be doing them, like using it for, right, to practice, right? If you can attempt some of these questions in the material, you can as well do what? Attempt it. Because the reason why I'm saying this, that's, I think, one or two questions are there. If you don't have the knowledge of bond valuation, it may not be easy because of credit rating and all that, right? So, however, please make sure you solve questions. The more you solve questions, the more you get exposed to all these terms, right? The more you familiar, all these formula you think is difficult to learn. Once you solve like 2 to 3 questions, wow, become familiar with it, right? Before you know, you start solving. So it is what it is, class, right? It is what it is. So, are we good?
Please take it back up so we can write. Take it back up.
Okay. Oh. Yes, sir. Please, do we have new member? If you are just joining us for the first time, if this is your first time.
This is my first time, sir.
Present.
Hey, madam. Ogatunde and madam.
Yes.
Okay, oh, you're welcome to Next Gen Professional Associates.
Thank you.
Okay. And Okoro as well, right? Joanne. Okay, you're welcome to Next Gen Professional Associates. And I'm troublesome. I can wake you up in the middle of the night to go and study.
Likewise.
That is very good. Yeah. Yeah, that's fine. That's fine. So you're welcome to Next Gen Professional Associate.
Thank you.
So we're on project-specific cost of capital. So maybe immediately after the class, you can just go to the YouTube. We have a lot of them in the YouTube. So just go there and check the question. We also have material, right? So one of the partners, she has been sending the material details to the platform. So I'm not in charge of that. So you can just chat her for the material and all that, right? So okay, so let's quickly look at another question. You can mute your mic.
Okay.
Let's quickly look at, okay, Wale, are you in this class?
So, Mr. Ibrahim, how do we get the contact of the person, sir?
The solution or the questions?
Of the material.
Okay, the material. Okay. Sorry. Okay.
I did this class too, but for like some days now, I'll be having a network problem. But I will go over with the video.
Okay, that's fine. That's okay, Mr. Tunde.
Sir,
you can get it. Once you pay for the material, you get everything. But you won't get the solution. No. That is my case, actually. Do you know why? Yeah, I know you understand why. Right? You understand why. So most students experience shows like over the diet that once you include solution, they will not even bother to go and check why is it like this. So that when you see another thing, you will not say, this is what IB said we should do.
Okay. So we can as well go through all the YouTube. Then if there's anything we don't understand, we can throw it to the platform.
Yeah, exactly. Yes, exactly. Yeah. So and the material is on is based on piecemeal, actually. Based on piecemeal. Like as we move, I drop it to the folder. As we move, I drop it to the folder.
Okay.
You get, but it is only the strategic management part of it, which my guy is handling. We'll be updating that one every week. Once you have the lecture, we'll update it. Although I'm here to update the last class, but I will do that immediately after this class. Thank you. Can we move?
Thank you, sir.
No, thank you. Olalikon, I think you have to just namesake, right? Just
good evening, sir. So I don't know, maybe this is the right time for me to ask this question. I wanted to know, is capital employed and shareholders fund, are they the same thing? Capital employed and shareholders fund
are the same. Capital employed and shareholders fund are the same. We are talking about capital employed could be defined as total assets, could be defined as total equity. So you are talking about shareholders funds, you are talking about total equity. Don't worry, this question will also expose you to all those things, right? We look at this question. I think it's one of the past questions as well, right? 30 marks question. I mean, is it 30 marks or 40 marks? Okay, 30 marks. Okay. We'll look at this question. Do you get namesake?
Okay, sir. Thank you.
Yeah. Okay. Now, please, you should not forget our principle. What is our principle is that you need to understand the requirement, right? So once you understand the requirement, it is assumed that you've solved 60% of the question, right? At NetGen, we don't cram question, we don't cram report, we don't cram case study. We write case study. We write anything that we want to do in class. We do it together in class, right? So please, we need to understand SFM so that when the worst case scenario, when you see the worst case scenario, at least you can, when you look at it, when the desirable is not available, the available becomes the desirable. So please, whatever thing you don't understand as we move, ask question. Thank you. Now, ignoring the project, calculate the current weighted average cost of capital of a co using the capital asset pricing model 8 marks. The Gordon's growth model 6 marks. Now, something should just come to your mind when you read this question. You've not even read the question, but you were like, project. ignoring the project. Could it be that this company want to diversify? Ignoring the project. It could be, oh, that's it. Now, using the capital asset pricing model, calculate the cost of equity that should be included in a weighted average cost of capital suitable for appropriate for appraising the project, and explain okay. Please, apologies. Please, can you just give me 1 minute? Sorry, just 1 minute. Thank you. Okay, sorry, please. So using the capital asset pricing model, calculate the cost of equity that should be included in a weighted average cost of capital suitable for appraising the project and explaining your this now. And explaining your reason. Class, use the capital asset pricing model. You know, if you use capital asset pricing model, what did you use it for? To calculate cost of equity. Should be included, of course, in weighted average cost of capital suitable for appraising the project. Definitely, they may have a new project. And the capital asset pricing model you will use, it will be included, of course, when you want to determine your WACC for the diversification, you have to calculate the cost of equity using CAPM. Now, by calculating an overall equity beta and using the capital asset pricing model, estimate the overall weighted average cost of capital of ECO, assuming that the project goes ahead, and comment upon the implication of the perimeter changes in the overall WACC 5 marks. The overall weighted average cost of what? Cost of capital overall, right? Now, what is the next question? Quickly, okay. Oh, wow. Discuss whether ECO should diversify, right? Diversify its operations and how the stock market might react to the proposed project. 3 marks. Identify the appropriate project appraisal methodology that should be used when a project financing results in a major increase in a market gearing ratio, right? What is the appropriate? And using the data relating to ECO, calculate the project discount rate that should be used in these circumstances. 3 marks. Total marks, 30 marks. So now let's start, right? So Inca PLC is a listed company. Is a listed company in food retailing sector, and as large stores in all holiday travel shops in all of its stores. At a recent board meeting, the director discussed how the holiday travel shops current weighted average cost of capital should be used to evaluate the director to evaluate. The director disagreed because the existing cost of equity does not take into account the systematic risk of new projects. He said that the company overall weighted average cost of capital, which reflects all of the company activity, would change as a result of the project acceptance. Right? Now, the board was also concerned about the market reaction to its diversification plans. For instance, you are producing beans now, and you want to be manufacturing cement. What is the probability that this cement that you want to start, people will patronize you, right? Now, another board meeting was scheduled at which Yinka's advisors would be asked to make a presentation on the project. You work for Inca advisors and have been asked to prepare information for the presentation. You have established the following. Inca intends to raise the capital required for the project in such a way as to leave its existing debt to equity ratio by market value remain unchanged. Their debt to equity to remain what? To remain unchanged. So extract from Inca's most recent management account. Now, what are the sources of finance here? Now, something should just come to your mind that, oh, Inca PLC want to diversify. And the first one is saying that the director disagreed that, oh, you should not use the existing one because of the risk. How are we sure that people will accept this particular project? And you have informed your investors that, don't worry now, people will patronize us, without factoring some risk that what if? Now, what are the sources of finance here, class? What are the sources of finance? What are the sources of finance here?
Equity.
Ordinary shares.
Ordinary share capital, yeah.
Bank loan.
Redeemable debenture.
Debentures. Bank loan and
bank loan.
Long-term bank loan.
Okay, that's fine. That's fine. Thank you. Now, on the 31st, 2017, don't forget that whenever they give you story, you can see that you've identified this as your sources of finance. Now, if you check the story after the financial, it will be the story for that ordinary shares first, then the other sources of finance. Now, let's check this. On the 31st December, on May 31st, 2017, Inca's ordinary shares had a market value of, can you see that they are giving us the market value? Can you see that they talk about ordinary shares, and the ordinary share is the first sources of finance. Had a market value of 276 kobo SDIV. It means that the dividend has been paid. One, and an equity beta of 0.60. An equity beta of what? 0.60. That is the equity beta, which is less than 1, indicating that the company's stock is what? Is not risky, right? Now, for the year ended May 31st, 2017, the dividend yield was what? 4.2%. And the earnings per share was what? 25 kobo. What is earning per share? What is the earnings per share? That is the profit, right? Class, is it not the profit? Class, is it not the profit?
Yes, it
Earnings.
It's that's CPS. Yes.
Okay. Now, the return on the market, that is market return, 8%. And risk-free is 2%. Now, don't forget, the required says that ignore the new project to calculate the current WACC using the capital asset pricing model and the Gordon's growth model. Now, let me finish the question first. Now, Inca's debenture had a market value S interest. This is S interest. It means that the interest has been paid. Now, the nominal, this is the nominal value, and they are redeemable. Remember, any debt that is redeemable, you use what to determine the internal rate of return? You use internal rate of return. Is that not so?
Yes.
Thank you. Now, for how many years now? For how many years? This redeemable debenture, for how many years?
17, 18, 19, 20.
4 years.
4 years.
4 years, thank you. 4 years, that makes sense. We use internal rate of return. But what if the redeemable debenture is just a year? You know that we are not going to use internal rate of return, right?
Yes.
Okay. Madam Sonia, do you know that we will not use internal rate of return because
Yes,
it is
sir.
just for 1 year? Is that not
Yeah.
so?
Yes,
Wale, Abdurrahman.
Yes, I get it.
I think we've done something like that
Abdullah.
before.
So, sir,
Yes.
what do we use?
Okay. Just check. Are you just joining us for the first time? Is this your first class?
Yes, sir.
Okay, that's okay. You can check cost of capital. Check. Maybe check part 1, part 2. You can
Okay,
check
sir.
it. Maybe part 1, part 2. Yes, we solved the question like that. So it's one of the past questions. Maybe I think last night question. Now, companies operating solely in the holiday travel industry have an average equity beta. Another company, can you see that there is a new project? You can see that they did not indicate this is the company, but they gave us the companies that are into that holiday travel industry. Have an equity beta of 1.40. This is the equity beta. It's even greater than 1. Okay, we have 1.4. We have the average debt to equity. Can you see? You can see that this is given in a percentage form. Debt to equity, 3:5. Debt is 3, equity is 5. Right? For the Proxy company, all these are for the Proxy. It is estimated that if the project goes ahead, the overall equity beta of Inca will be made up of 90%, which means that don't forget that the equity beta of Inca PLC is less than 1. But if they go ahead with this project, they are better. The risk will increase to about 90% for the food and 10% holiday travel shops. That is 100. Assuming that the income tax rate will be 20% for the foreseeable future, ignoring the project. Calculate the weighted average cost of. So we have to calculate weighted average cost of capital. Now, if we are ignoring the new project, all these jargons here, we are ignoring the new project, right? We ignore the what? The new project. Ignore the project. Now, what it means is that if we are to determine our cost of equity, we will use capital asset pricing model. We will determine the WACC. When we are done with that, we will move to the Gordon's growth model. Class, we will use the Gordon growth model to calculate the cost of equity. Then we will now calculate the what? We'll calculate the cost of equity, we'll calculate the cost of debt, then we will now calculate the what? The WACC. That is what it means, class. So, suggested solution. I think you can actually complete the question. Let me just start. I don't want to come back to this question, child. Let's say suggested solution. The name of the company is very important. Inca PLC. Inca PLC. The sources of finance, our steps, ordinary shares, so we have to use what is this now? CAPM to determine the WACC. Then we'll still calculate, excuse me, we'll still calculate the cost of debt. Okay. CAPM. So what is the formula? Cost of equity, risk-free, equity beta, market return, minus risk-free. So what is the risk-free given to us in this question? Quickly. Risk-free class.
2%.
Okay. Where is it, self?
It's up there.
Okay. Can you see it now? Let me bold it in case. Okay. Risk-free.
2%.
What is the equity beta of the company? 0. What?
0.06.
0.6.
6. Market return is what?
8%. 8%.
Is 8.
8% minus 2. What is the cost? What is the cost of equity? Who is that now?
0.06. 0.06 or 6%.
Okay. Rose, we'll fight to Rose.
Hello, my boy. Good man, lost.
Okay.
Sir, I'm getting 5.6. So
It's
cost of everything, I'm getting
5.6.
5.6.
Okay, 5.6. Okay. 5.6 or 6%. So we need to determine the first sources of finance is ordinary shares. What is the next sources of finance, class? After ordinary shares, what do we have?
Debenture.
Ordinary shares.
Redeemable debenture.
Yes.
Redeemable.
But we need to get market value.
Sir, what about the
thank
market
you.
value of equity there?
Thank you. Imagine. I don't use that one drink Gary this evening. Don't mind me. So, total market value, right? Total market value. So I don't need to bring out the formula. We already know all those things, right? So what is the value of ordinary shares?
That's
the value of ordinary shares is
233.
233 divided by the nominal value. What is the nominal value?
0.1. That is
0.1.
0.1. We give you the numbers of shares. What is the market value SDIV?
2.76.
You divide it. If you divide it by 100, convert it to Naira, what do you have?
2.76. I think
2.76. So what do we have?
6431.
6431. Class, don't forget that sometime, like the first question we did, I think the second question we did, no, the third question that we saw under cost of capital, right? Whereby the total market value is given already. So what do? We just move, right? It is given to you already, just make use of it. You don't need to calculate the total market value, right? So in this case, we just have 276 kobo. Just convert it to Naira, right? Just so that you have your, so you have, just divide it by 100, you have your Naira, then we move like this, right? So what is the next sources of finance, class? What is the next sources of finance?
Redeemable debenture.
Redeemable debenture. Right? Redeemable debenture. But because it is redeemable, we need to use internal rate of return to determine the cost. So what is the market value? Just give me from the question. Market value as interest.
108.
As interest. 108. It is per debenture. Don't forget. Sometimes this market value as interest. Don't forget the last question we did under cost of capital. Class. Sometimes this market value as interest, they may give you the value, the market value. You know, you will not use the value. You have to divide it by the numbers of bond or by the numbers of debentures so that you get per one. Just like the way we did in the last question we did, we solved under cost of capital. Please, that question is the worst case scenario you may see. And it's very important for you, for everyone to go back to it again and check. I think cost of capital part 3, right? If you check part 3, is actually there. Right. Now, after this, we have what next? Market value as interest. What else? What are the ingredients, class? Interest.
We also need the redemption value, which is 100.
Yes, the interest first. What is the interest attached to the redeemable?
6%.
6%. So if I want to convert this 6% now to Naira, I will multiply it by the nominal value of 100. Then I will have 6 Naira. Then I can do my tax relief on interest. Don't forget that I said there are 2 ways of doing this. You can use interest 1 minus tax rate. You still have the same thing, right? Tax relief on interest. How many percent?
20%.
Is it 30 divided by 100?
It's 20.
20%.
20%.
Okay. Times 6. Times 6. What do we have here?
4.8.
4.8. Don't forget, if you minus 6 minus 4.8, whatever you have, or you say, or you use interest, open bracket, 1 minus tax rate, you still get the same thing. If you minus 6 minus 4.8, if you do interest 1 minus tax rate, it is still the same thing. Right? Now, what's next? We have the redemption because it is the redemption value is 100. The numbers of years. What is the numbers of years, class?
4. I think it's 4.
Numbers of years. Please confirm. Numbers of years.
4 years.
Is 4 years. Thank you. Let me quickly copy this. Positive MPV, right? And negative MPV. Wow. I'm not sure. It's not here. Okay. To save time, right? But that's fine. Let me quickly do that. Don't forget that positive MPV. To get positive MPV, you use what? You use what? Which DCF?
We use 2.
Sir,
2%.
so this tax relief on interest. I don't know. I'm getting 1.2. I don't know.
Sir, tax relief on interest is 1.2 now.
Yeah, 1.2 multiplied by 4. 4 years.
No, you are not multiplying it by 4. Just do it one after the other. Okay. 1 point what?
Yes, what I'm saying. Yeah, 1.2.
No, leave it. Ogawale. Thank you. Just no worry. 1 to 4 years. 4 years, right? We understand you. You don't go far now. 1 to 4 years. Let's do it this way. Now this one we understand though. Year 0. Right? So present value. Wale, you're actually right too. You can do it that way, but I just want to simplify it, right? Do you get Wale? You know now.
Yes, I get it, yeah.
Yeah. Interest. Right? Market value S interest. 108. Please, because of the Naira sign, right? Oh. Quickly, we can just. Okay. So we use 2%. 2% we give positive MPV. The higher the MPV, the lower the DCF, the higher the MPV. That is the logic. So you don't need to. It is trial and error, right? The lower the MPV, the lower the DCF, the higher the MPV. So interest rate. Year 1 to 4. Is 6 Naira. So someone should calculate, give us an annuity figure.
The interest we are going to use this. Okay, don't worry. Annuity is 3.808.
What is the annuity? 3.808. 808. So this is 1.2, 3.808 at the last year, which is the redemption. We can have this 100. So what is the DCF? You know, this will not be annuity. You've paid interest from year 1 to year. Oh, wow. I didn't send this thing to the platform. Wow. Okay, that's fine. So please, what is the DCF?
0.924.
Okay, that's fine. 0.924. 0.924. So when you multiply, what do you have? Who is that? Oh, Wale. What do we have? When you multiply, what do you have? Quickly.
22.848.
22.848. When you multiply this,
570.
what do you have?
4.570.
4.570. So when you multiply this, what do you have?
92.4.
92.4. So what is the positive MPV?
$2.678.
Okay, coming. $2.678. So this gives us positive MPV.
Yeah.
So we can just use 10%. Use 10%. 10% should give you negative MPV. Right? 10%. So we have to change this. So what do we have? What is the annuity figure?
$3.170.
3.170.
170.
3.170. 3.170. So what do we have here as the DCF?
$19.02.
The first one, 19.02.
19.02.
Okay, what do we have here?
$3.804.
3.804. She will not go sleep here like this. Mukuna, give me figure so that we can move, please. Out of the DCF,
0.683.
What's that?
0.683.
0.683. Madam. So what do we have? We multiply.
0.683.
So when you multiply, what do you have?
68.30.
68.30.
Yeah.
Okay. So what do we have? Do we have negative MPV?
Yes, minus 24.484.
24.484.
Negative.
Right. So we have to apply. I'm supposed to have this thing. I will just copy it from. Sorry, please. Let me copy this formula big. So internal rate of return, right? So lower rates, right? I'll just need to copy this.
Minus.
Lower rate plus
Positive MPV divided by positive MPV plus negative MPV.
Thank you, madam. Your head there. Lower rate is 2%. Right? Is 2%. The positive MPV. What is the positive MPV, class? The higher rate is 10%. This is 2% or 2. The positive MPV is this. Positive MPV. Right. So this I just need final figure. 678. What is the negative MPV?
24.484.
24.484. So internal rate of return, what do we have?
Approximately 2.8%.
2.8. That is the cost.
The total, yes.
Okay. 2.8%. Please, others should confirm. 2.8%. It will be small. 2.8% is 2.8.
Yes.
Okay. 2.8. That's
It's
fine.
correct.
Okay. Lower. Yeah. Yes. It should be 2.8. Yeah, it should be 2.8. So let's quickly move. Rose.
Sorry, I have a question. What if the both NPVs were negative?
If no, they cannot be negative.
Okay.
Rose.
Yes, sir.
One will be positive, one will be negative. The formula, if you check the formula, there is minus there. Minus times minus is plus. So that is why we just say plus negative MPV. Do you understand? For you to get your positive, you look for use the lower rate, 2%. Negative MPV, look for the higher rate, which is the 10%.
Oh, okay. Okay, I understand now.
Okay, thank you. So what is the total market value? Total market value. So what is the value of redeemable from the financial statement? Quickly, class. What is the value of redeemable?
1,900.
1,900. So you just give me a figure, right? So that's 1,900. What is the nominal value?
100.
Is 100. What is the market value? S interest, sorry. What is the market value as interest?
108.
108. What do you have?
2052.
2052. Right, 2052. So which other sources of finance do we have? Preference share, right? Okay. Okay,
Long-term loan.
Long-term loan. So let's quickly check. That is the loan notes, right? So long-term loan. Where is it? Long-term loan. Okay. This is it, right? Oh, the long-term loan, bank loan, right? Sometimes you may have a bank loan, right? That is actually a long-term, right? So no information. You don't forget that you cannot determine the market value of a bank loan, right? If it is bank loan, in as much that it is bank loan, if it is bank loan, right? Long-term bank loan. Class, what is the formula for calculating the cost of bank loan, whether long-term or short-term? What is the formula? Unless if it is stated in the question that this is what they have. Esther now. Right? Unless if it is stated in the question otherwise. But in the notes here, there's nothing that is being stated that sometimes they may tell you that the bank loan is redeemable. Please always read through the story. Right?
Sorry, sir. If it's redeemable, how will you treat it? If the bank loan is redeemable,
you use internal rate of return. Any debt that is redeemable, use internal rate of return. Any debt at all.
Okay, sir. Okay, sir. Thank you, sir.
Yeah, you're welcome. So what do we have? What is the formula for calculating bank loan?
Okay.
What is the formula?
I think it's the interest bracket 1 minus tax all over the market value.
Bank loan.
Interest 1 minus
I-
tax.
Interest 1 minus
Interest
tax.
brackets open and close 1 minus tax rates.
Thank you. You cannot determine the value, the market value of a bank loan, whether long term or short term, unless if it is stated otherwise in the question. Unless if it is stated otherwise in the words in the question. Right? Now, what is the interest rate? 4%. 1 minus tax rate. What is the tax rate? What is the tax rate? 20%.
20%.
So what do we have? What is the cost? 3.2%. So this is the cost of bank loan. Is equal to 3.2%. That will be the cost of bank loan. So we are done with this part. We are done with it. Just wait. Just hold on, please. Just hold on. We are done with this part, right? So we need to calculate the weighted average cost of capital. So how do we determine the weighted average cost of capital? Items. We can use what is it called? We can use the other one instead of using hash total, right? Weighted average cost of capital equals to, let me copy formula back to save time, right? I'm coming. I will answer your question. Okay. So let's save time.
We can also use tabular approach.
Yeah. Hash total, you still get the same answer, right? So WACC. Please don't forget that you need to know this formula, right?
What about your
Very, very
preference?
important.
Please, what if
do we have
use
preference
the
shares?
normal one, the one that has a hash total?
Anyone that you want to use.
Because cramming all these
Where
plenty formulas
did you
hard.
see preference shares? Where did you see preference shares?
Oh, sorry. I thought it was preferentials.
So whichever one you want to use, go ahead and use it to. Me, I just want to save time. So, value of equity. That is market value of equity. I've calculated it already. Then the market value of debts. How many debts do we have here? 2 debts, right? So what would be the total market value of bank loan? Don't forget the value. Bank
635.
loan. 635. Don't forget this. The value of the bank loan. The market value of the bank loan is still the same thing. The amounts given in the what? In the question. Right? So I want to just save time. Is that not so? So that we can move forward. Right? Or should we use hash total? Okay.
No.
Right.
Continue with this, please.
Continue with another one.
Total market. Cost of capital. Sorry. Hash total. So what is the items? Ordinary shares. Don't forget his cost of capital is CAPM. Let me put CAPM because that is what we use to determine this. So what is the total market value, class? What is the total market value?
6431.
6431. So what is the cost of equity?
6%.
6%, 0.06. So the next one is debenture. If I have time, I will do the other one, right? If I have time. So debenture. So what is the
2052? 2052.
2052. So what is the cost?
3.2.
3.2. 3.2 is equals to 0.32, right? No. 0.32, right? Is it correct?
Yes. Yes.
Okay. So bank loan, the market value 635. Our debenture is still 3.2. Debenture is 2.8 now. Who is giving me this figure? The cost of debenture is not 2.8.
Yeah, it's 2.8.
It's 2.8.
Okay,
So you can round up
2.8. So this will give us 0.028. Is this correct? Please confirm.
Yeah, that's correct.
Yes.
It's correct.
Confirm. I drank Gary this evening.
I follow your drink.
Thank you. So what do we have? Total, what do we have?
Ordinary share is 385.86.
0.86.
385.86.
385.86, right?
86, yes.
So what do we have here?
57.45 or 46.
57.46. Okay.
Then 20.32.
20.32. Okay. Okay, so what is the total? Ash total, what is the total?
9118.
Which one? Is it the ash
That's
total?
total market value.
So what is the total market value?
9118.
9118. Madam, I beg. I want to, I beg, please, don't miss my class so that you'll be giving me figures, please.
You pay me.
Thank you. No problem. Thank you.
No
So what do we have here?
Hash 463.64.
463.64.
Yeah.
Okay, therefore, WACC equals to hash total 0.64 divided by 911.918 times 100. What do we have here?
5%.
5%.
5%. Okay, so we are good with this. So we've already used the capital asset pricing model to determine the weighted average cost of capital. You know, you will not use only capital asset pricing model. You have to include the what? The debt, right? You have to do what? You have to include the debt. So the same thing we are going to do with Gordon's growth model. Using the Gordon's growth model, we already calculated the debenture, the cost of debenture, and the cost of bank loan. So we just move on from there. So Olalekan.
Good evening, sir. So I
Yeah, good evening.
ask that the long-term loan that you mentioned.
Please, can you be audible?
The long-term bank loan. What if it is loan stock? Is it the same thing as long-term bank loan, or is it two
No,
different
no,
things?
no. No, it's different thing entirely. Oh. If they say loan note is different from long-term bank loan. Oh. Loan note is actually what? It's a traded debt. They can use it interchangeably. Either they say debenture or loan note. This is bank loan, whether long-term loan, bank loan, or short-term bank loan. Bank
Or
loan
loan
is
stock, or loan stock as well. Right.
or loan stock. Yes, anyone.
Okay. Okay, sir.
Hello,
Okay,
sir.
thank you, sir.
Hello, sir.
Yeah, I'm with you.
Hello, sir. Okay,
I'm
sir.
with
Please,
you.
for
I can hear
for
you.
the debenture. I don't know why they do for the debenture, sir. They did they divided 1,900 divided by 100. Where did the 100 came from, sir? And again, I thought I saw 6%. I don't know why the 100 came about, sir.
Have you been following our classes first? Have you been following our class?
No, sir. No, sir.
That's why now. So that is the nominal value. So once you watch the video, you can go and watch other videos on cost of capital. So you multiply by 100, which is
It's
the
about the
nominal.
6%. The 6%.
Yes, the 6% is from
Okay, sir, but what happened to the 6%?
For which of the 6%? Sorry.
If you go up, sir. Go up to the question, sir. Let me show you. Yeah, hey. The 6% redeemable debenture at nominal value, redeemable 2021, 19. So they ignored the 6%. We didn't use any of it, sir.
Okay. Oh. Where did you use it here, Maoga? 6%. Is it not 6% that you see here? It's the interest.
Okay.
Redeemable.
Okay.
Do you get?
Okay.
So please, what I would just advise is for you to go back and watch the video on the cost of capital so that you have understanding of all this. If I start to explain now, Kai, we no go come off for here. Do you understand? So I believe you understand it.
Okay, sir.
Thank you. So quickly, wow. Okay. So Roma figure 2. Roma figure 2. Using the Gordon's growth model. This is where the problem is, right? Gordon's what? Growth model. Now, if you want to use Gordon's growth model, there is a formula for calculating the cost of equity. What is the formula? Cost of equity equals to D1 DO 1 plus growth rate, right? 1 plus growth rate plus growth rate divided by the market value as div. The market value is still equity, but you will use Gordon's growth model. Right now, don't forget that the growth rate class, you are not going to use, you can either use extrapolation or the Gordon's growth model. But the question says use Gordon's growth, meaning that you will use Gordon's growth model to determine the growth rate that you will use to determine what? The cost of what? To determine the growth rate, so that we'll use that to determine the cost of equity. That is the Gordon's growth model, right? Now, if you want to use Gordon's growth model, we need to determine the growth rate. That is the first problem. Is that not so? We need to determine now, what is the dividend first? Let's calculate what is the dividend. The D1. I don't know if this will take me wow, 24%. Okay. So okay. So what is the dividend? What is the current dividend first? we need to establish that. So from the question, let's quickly go back. From the question, what is the dividend?
I think it's 4.2, sir.
The dividend yield is 4.2. They did not say this is your dividend, though. They say what the dividend we yield is what? What the dividend we yield is 4.2%. They said what the dividend we yield, right, is what? 4.2%. So finger crossed, right? Let's see. Let's work it out together. We are given dividend yield. We need to determine dividend per share. We don't need dividend yield. What I need is just dividend per share. Now, dividend yield, what is the formula for calculating dividend yield? That is dividend divided by the what? Market value, market price. Class, are we still together?
Yes, sir.
Is it not the formula for calculating the dividend yield? Dividend divided by market value as div, right? Dividend per share divided by, okay. Now, dividend yield is given to be what? 4.2%. What is this now? 4.2%, right? Equals to, the dividend is not given. So we can say, let S represent dividend. Class, are we still together? Let S represent dividend, S. Divided by, what is the market value S div of the ordinary shares? What is our market value S div? What is the market value S div? 2.76. Thank you. 2.76. 2.76. If you divide it by 100, in case you are wondering how do we arrive at 2.76, divide it by 100 so that you get nearer, right? Now, you remember what we used to do those days, right? Secondary school or primary school. Is it primary school now? Yes. We cross multiply. So when you cross multiply, what do you have? What is dividend? Dividend per share is what? What is the dividend per share?
2 times 2.76, which is 11.5.
0.9.
Just convert this 4.2%. What do you have? 0. What?
0.1159.
Ah, I'm confused.
0.11592.
0.11592.
Okay, 115. Okay, let's say 115 is okay.
116.
So
So 116.
Okay, that's fine. So this is our dividend per share. Please just follow. Interesting. I like this question, right? It makes sense. Dividend. I'm coming. So the market value as div is equals to 2.76. I'm just bringing them out, right? 0.76. Now, the next thing we need to determine is the growth rate, right? Is the what? Growth rates. We'll have our current dividend dividend per share to be 0.176. We have the market value as div to be 2.76. Class 2.76. Now, Gordon's for the growth rate equals to R times B, right? So where our R is our return on investments. Return on investments. If you want to calculate your return on investments, return on investment is calculated as, for those who watch that video, FM. Yes, I did something like this in FM's class, right? Divided by the what? Opening shareholder funds. Class, this is just English. Opening shareholders fund is your equity. Opening shareholders fund means, under your changes in equity, you will bring in the retained earning of the previous year as brought forward. You will add profit for the year. You will deduct dividend for the year. With that, it is not what you have will be your total equity. It is not your total equity. It is your total equity, but not your opening shareholders fund. Opening shareholders funds means the previous year shareholders fund, the previous year total equity, excluding the current year retained earning and the dividend paid, and profit and dividend paid. This is it. It does not include the current year. Class. Now, quickly before we go, wow. Okay, let me quickly just do this part, right?
Sorry, sir, please can you recap again on this opening shareholders funds?
I've moved on. Okay, opening shareholders fund. Under your statement of changes in equity, right? You have your brought forward of your retained earning, brought forward. Bam. You have your profit for the year. Bam. You deduct your dividend. You will have your what? Total equity. Now, with that total equity as include the previous year the equity fund plus the current year. But what we need only is just for the previous year. We don't need the current year. Anything that has to do with retained earning for the current year, we don't need it. We only need the previous year. That is why it is called opening class, opening. We don't need the current year retained earning. Class, are we still together?
Sir.
Yes.
Now, thank you. Now, in this case now, right, we can move forward. Okay, now we'll move forward now. Profit after tax. Okay, let me quickly round this. So what is the profit after tax? That is our earnings, right? Where is our profit after tax? Where is it? This is the earnings. Is that not so, class? Class, this is the earnings. Is that not so? Per share.
Yes.
25.
Yes.
So now let's get the total earnings. Let's get the value. Is that not so? We need to multiply by the numbers of shares. Don't forget, this is 25 kobo per share. This is equity. We need to multiply by the numbers of share. I need someone to give me what will be the numbers of share? 25 kobo, right? If you divide it, what do you have? 25 kobo. That is 0.25, right?
Yes.
0.25. Don't forget is times the numbers of shares. What is the numbers of shares?
Let's see. 233. 233.
Now, how did you arrive at your 233? 233.
Okay.
Divided by
100.
There is 100.
2330.
2330 million.
233 divided by 10, by 0.1.
0.1.
So what do we have? What is the numbers of shares?
2330.
2330. 2330. I'm coming. I beg, no be magical. If you did not understand.
Okay.
2330. Right? Okay, it's in shares. 2330 shares. Please. If you did not understand, let me know. Okay. Right.
That means I don't understand though.
Not plastic.
Okay. Oh. You understand profit after tax. You understand that this 0.25 is earnings. Earnings means there are profits, and it is they give us in per shares. Therefore, we need to get the total profit after tax, the total earnings. That is the reason why we divide it, we multiply it by, you know how we calculate numbers of shares now. That one should not be a new thing, right? Right. So it is what it is. Esther. 17.
So why are we not dividing 2330 over 0.1, sir?
We've done that already now. Should I be doing it again, Maoga? That is what gave us 2330.
Okay.
Yeah, divide it. Should I do it? Should I show the workings? 233 divided by 0.3.
0.10.
Okay, what do we have? If you have 233 divided by 0.1, what do you have?
2330.
2329.
Yeah? How?
It's 2330.
2330.
2330.
Okay. Yeah, but I think that 233 is a million. That 233 is a million.
Abdurrahman, put it a million. If you want to put it a million, you get, so that we can move on. If you want to put it in million, we know that it is in million. It is written there. You can put it in million so that we can move on, please. So opening shareholders fund, right? Don't forget, we don't need the current year retained earning. We need the previous year. Now, let's quickly go back to the question. Now, what do you have here? You have, this is your total equity. Class, listen, finally, before we go, you just complete the weighted average cost of capital, right? I'm only interested in this part. Now, you have, this is the total equity. Plus, this total equity of 5263 in 2017, as at 31st May 2017. As at 31st May 2017, right? Now, this total equity, it includes the current year. Class, this 5263 include the current year. It has included the current year retained earning. It has been added to this. That is what gave us 5263. Because in your statement of financial position, you would have done that in your statement of changes in equity, which will include the previous years as well as the current year. Right? Now, with the knowledge of financial reporting, this includes the previous year and the current year, but we don't need the current year. This 5263 has included the current year retained earning. We don't need the current year retained earning at all. We need the previous year, which is 2016. That is what we call opening shareholders fund, the previous year. So therefore, we need to remove the current year retained earning quickly. Oh, where is this now? Okay. Let's say total equity. What is the total equity? 5 what? What is the total equity, class?
5 to 60.
5
5
to
to 60.
okay, 5 to 63.
260.
Yes. 20. Okay. Retain any. Retained any for the current year. What is the formula for calculating retained any? Profit after tax minus the dividend. Is that not so, class? Is that not so, class?
Yes, sir.
Yes,
Okay,
sir.
thank you. So what do we have here? What is the profit after tax? If you multiply this, what do you have? 0.25 times 2,000 times 2330. What do you have?
582.5.
582.5 minus minus what is the dividend paid? What is the dividend? 0. What?
0.116.
116. 116.
So that is per share now. We need to multiply. We need to multiply it by the numbers of shares. Is that not so? Profit after tax. What is the profit after tax? Sorry. What is the profit after tax? Quickly, class. 5 what?
582.8.5.
58.
2.5.
Okay, 3.5.
2.5.
582.5.
Yes.
So dividend. The dividend per share is 0.166. 116 times what is the numbers of shares? 2330 shares. What do we have?
270.28.
270.28. If you check the Pathfinder, you will not see it this way. I'm just taking my time to explain. That is why I say if you understand something, you can twist it. At the end of the day, you still have the same thing, right? You just have to understand what you're doing, right? You just get it right. So, if you deduct it, what do you have?
312.22.
312.22. So we can deduct this as our retained earning for the year. This is the retained earning for the year, for the current year, right? So opening shareholders fund, opening shareholders fund. What is the opening shareholders fund? If you deduct it, what do you have?
4950.78.
4950.
4950.78.
0.78. So this is our opening shareholders fund for the year 2016. This is for 2016. 2016. So I think I have to stop here. Right. In our next class, please, you can complete this. This is the most, I think, the difficult part of this question is just this part. It's not even difficult, though. We just have to do some plus and minus, okay, so that we can get the answer right. So, please, I think I have to stop here. Now, our next class, right? We'll start. I think our next class is on Saturday, right? So 12 12 noon, right? 12 noon. So hopefully we should be able to move. We should be able to check on on either board valuation or investment appraisal. So we should not forget what lead us to this part, to cost of capital, right? Because of the function of a financial manager, which are investment decision, financing decision, dividend decision. Investment decision will take us to investment appraisal. The financing decision will take us to the sources of finance, which we are in sources of finance, which is cost of capital. As a financial manager, or as an investment analyst, or as a portfolio manager, right, you should be able to advise the sources of finance, either going by equity or going by debt. At the same time, you should be able to advise when the company wants to diversify into into another line of a business, why we have to include risk, right? Now, we'll now be looking at the investment. You've identified the investment, you've identified the sources of finance. Now let's go into the investment. So in our next class, we may look at investment, or we may look at the bond valuation. The bond valuation, we'll be looking at bond valuation. You are the holder. Thank you. You are the holder. So we're looking at it that, okay, you are not even expecting, you want to see your return on investment under the bond valuation, right? We'll get either bond valuation or investment appraisal, but as the spirit leads, right? I would think of which of the topic we need to treat first, right? Bond valuation or investment appraisal. So on this note, I think we have to go. Thank you so much, everyone, for joining. I just have about Dari. Thank you so much, everyone, for joining, and enjoy the rest of your evening. Dari, quickly.
So
I'm with you.
See this 582.5 we have for profit tax. Can you hear me, sir?
Yes, I'm with you.
That figure is actually profit before tax.
Oh yeah, it's profit before tax.
Yes, sir.
Okay, I will check it. I will check it in our next class. We'll
because they said that any per share is 0.25.
They've already said earnings per share. Definitely, they've considered tax.
Okay, they must have considered tax in it already.
Yes. They've already said earnings per share. Is their earnings? That is what the investors we have. So
okay. Thank you, sir.
Yeah, you're welcome. So I think we have to go.
Are you on YouTube?
Yes. Just check YouTube now. You see it here.
Thank
you.
Just
check YouTube now. Yes, I think
So I would not solve for B. B.
Which B?
It's only R.
We haven't finished.
You want us to sleep here?
Thank you so much, everyone.
R times B, sir. I mean R times B.
So you can complete that one, please. Thank you so much, everyone, and enjoy the rest of your evening. Thank you, and bye for now.